China Automobile Parts Holdings Limited's auditor, PKF Malaysia's Sanjaya Lambohard, has retracted its audit report for its financial year ended December 2015. The audit firm said this is because the report does not represent a true and fair view of the financial position of the company. It's an unusual move and the first of its kind in Malaysia involving a public listed firm. PKF said the reason it was doing so was due to undisclosed litigation cases involving a subsidiary of the company, Chuan Chou Fensun Automobile Parts Co. Limited. It said it only discovered them after the report had been signed. The audit firm said that since the financial effects of these undisclosed events have not been determined and accounted for by the directors in the company's financial statements for FY15, the audit report issued with those statements cannot be relied upon. It adds that some or all of these undisclosed events may have a material adverse impact on the financial position of the company and may involve potential breaches of the applicable security laws and/or Bursa's listing requirements. In total, there are cases against Fensun to the amount of 163.75 million ringgit. PKF also noted that despite raising the warning flags, no actions were taken by CAP. In addition, PKF warned that in the light of these developments, a question mark should exist over CAP's FY14 numbers. Felda Global Ventures Berhad has come out to deny that it had committed deforestation in West Kalimantan to make room for its oil palm plantation. FGV had issued a statement to Bursa in response to allegations by Chain Reaction Research and partner Aiden Environment that it had committed the act. Chain Reaction had written that FGV's RPSO credentials were at risk, alleging that its subsidiaries had cleared 880 hectares of high conservation value peatlands. According to FGV, the Indonesia-based independent assessor found no evidence of deforestation of natural forest, and that in fact the natural forest had been completely destroyed by massive forest fires and continuous logging before FGV had even bought the land. FGV went on to say that it has complied with all RPSO procedures and procured all necessary approvals. Baustat Heavy Industries Corp Berhad returned to the black for its first quarter of 2017 in line with its top-line growth. Compared to a net loss of 19 million for the same quarter last year, BHIC recorded a net profit of 2.7 million, while revenue grew by 22% from 63 million last year to 76.8 million. According to BHIC's Executive Deputy Chairman and MD Tan Sri Ahmad Ramli Muhammad Noor, the higher revenue from defence-related maintenance, repair and overhaul activities contributed significantly during the quarter. Ramli added that the recent staff rationalisation undertaken by BHIC has borne fruit as it tightens the reins on costs. For the coming months, the group is confident of keeping its growth momentum following a recent series of contract wins, the most significant being a contract to supply 4 units of littoral mission ships for the Royal Malaysian Navy worth an impressive 1.17 billion ringgit. Ramli explains that the first 2 units of those ships will be built in China, while the next 2 will be built at Baustat Naval Shipyard in Lumut. Aside from that, the group will continue to pursue contracts with other parties, such as the Royal Malaysia Police, the Maritime Enforcement Agency, as well as in foreign markets. Property developer Titijaya and Lambohard saw its third quarter net profit increase by 26.8% due to better cost management. Net profit came in at 19.2 million compared with 15.2 million a year ago. However, revenue came down by 32% to 70.5 million from 103.6 million in FY16. Titijaya's MD Tan Sri Lim Soon Peng said that the group was on the right track to achieving its FY17 300 million ringgit sales target. He is expecting FY17's numbers to be better than FY16's through continuous sales and existing project progress recognition, adding that based on his latest preview that the outlook for the market is turning positive, especially in the affordable segment. Tijaya's current pipeline includes a slew of projects with a GDV of 1.8 billion ringgit to be launched in FY18. Marsing Group Berhad is planning a 1.3 billion ringgit GDV development in Sentul via its brand new acquisition. Marsing is acquiring a 78% stake in Cosmo Wealth Housing Development Sanjaya Lambohard for 54.96 million. Back in May, Cosmo Wealth had bought 3 parcels of land in Sentul, measuring 8.5 acres for 95.07 million. According to Marsing, it is planning a residential development for the space, named M Centura, comprising service apartments with a starting price tag of 326,000 per unit. This buy brings Marsing's total land bank to 2,336 acres. Masing's Group MD Tan Sri Long Hai Kam explains that with this purchase, 65% of its land bank currently sits in Klang Valley and is aiming to increase that number to 75% over the next 2 to 3 years. Adding that by stepping up land acquisitions in Klang Valley with focus on affordable pricing, it will be better positioned to meet market demand.